Hello and welcome to this episode of The Sumerian Investor. This is Mohammed Al-Harib. I'm a licensed real estate agent in the state of Utah. Today we have Tyler Stevens. He's a loan officer and he has been doing it for a while. So Tyler, tell us a little bit about yourself, how long you have been doing this.
So I've been in the business, let's say, for about 10 years now. I actually went to school at UVU for a business degree before this. And then I decided that I really like doing loans. A friend of mine got me into it. So I'm with Security Home Mortgage. I'm father of three and a jack of all trades or a master of none. I don't know.
Cool. So you have been doing this as a loan officer for 10 years.
Yep.
Have you done any previous jobs before this?
So I was actually in schooling prior to this. And then while I was in school, I was actually a licensed airline mechanic, so an aircraft mechanic for large airliners out at Salt Lake International Airport.
And you decided to stop doing that and do loans.
Yeah, I mean, with working nights and weekends for 10 years and then never being able to get off of that was really kind of a hamper on the family life.
For sure. Okay, well, I do have a few questions prepared for you.
Please.
So take your time to answer. Obviously, the first questions I always ask is, as an immigrant, there are a lot of immigrants out there. And one of the questions we have, what documents do we need to apply for a mortgage or a loan to purchase a house?
Well, I'm going to answer this in the sense of being a perfect borrower. So let's talk about this. So the biggest things that we need to do are, first off, in order for us to know what you qualify for, that's kind of where we're going to head on this one. The biggest things are going to be making sure that you are a U.S. citizen. So usually we ask for anything from driver's license or, let's say, a green card, anything like that. Then we go to your pay. Okay, so like we'll need your two most recent pay stubs.
I'm sorry, I have to stop you here before you go to the pay.
Yeah.
So just to let you know, as an immigrant, you don't have to be a U.S. citizen to be qualified for the loan.
Correct.
You can be a resident.
Correct.
So having a permanent residency or a green card still will allow you to get a loan.
Mm-hmm.
And there are some sort of visas,
Correct.
I guess, that will allow you to get a loan. So you don't have to be a U.S. citizen to apply for a loan. Keep going.
Yes, that is actually 100% correct. That's actually the nice thing about being in the United States. You are legally a resident if you are here and you are working. And so that's actually really quite nice, right? Because then you get to enjoy what it is to be able to own a home. A non-resident
without
is
being
just fine.
An American citizen.
Exactly, right.
Yeah, a non-citizen is just fine.
Okay.
A resident is required.
Yes.
I know it's a little bit complicated, but you got it.
Yeah. And then the next thing is like, let's say, for instance, you have any extenuating circumstances or something that's different than what you and I just kind of discussed there. Yeah, just ask. And then we can kind of go over it, because you did mention visas. There are visas that do allow you to also purchase a home, just like you said.
Absolutely.
Don't count yourself out unless we absolutely make sure that you can. So now moving on
to the income.
Yeah. Now moving on to income. So income, usually the general rule is 2 years of work history. Now that would entail that we can even go back to, let's say, for instance, going back to, if we can document it, if you're from Iraq, if we can contact your employer and they can write us a letter of employment stating that you worked a certain amount of dates, we can even use that information. Schooling, same thing. It's a part of documenting that you are willing and able to go to work and you have a history of showing up. And how we do that is by actually looking at your two most recent pay stubs, your 2 years of W-2s, so the document that you receive every year from your employer. They'll actually send you that document and we'll just take a peek at that. And that kind of just gives us the general idea of proof that you worked.
Exactly.
And
you mentioned here a very good point that as an immigrant, you don't need to have you could, but you don't have to have 2 years of working history inside the U.S.
Exactly.
You could use maybe a year or 6 months prior to entering the U.S. Let's say you are working in Europe or in the Middle East.
Yeah.
And we just need the employer contact info. Once we verify that you have been employed and getting paid in your own country or any country before entering the U.S., that will still count toward the 2 years of work history.
Exactly. And the nice thing is as long as there's an email, it's kind of nice nowadays. It was harder back when we weren't able to email, but if I can send an email out and request information, and as long as I can get that back from your employer, I can use that as your work history. And
fantastic.
I mean, saying, I've helped somebody from Africa. I was able to email this person and they were able to send it back to me. And just like I said, don't count yourself out until we call or figure it out. So
very good. That's the point of this interview, is trying to clarify a lot of false information floating out in the universe and making sure that, hey, you don't need that, you need this. And so, listen to Tyler when he's saying that.
The idea is we go through all of it together. And then as far as making determinations, we can work through it together and make sure that it all works. And there are even loans. Again, like we first started, we talked about being the perfect person or the perfect borrower in this case. There are loans out there where you don't even have to work in the United States. You could be in China, you could be in Iraq and still purchase a home here. It's just a different type of loan and they require a little bit more outside of the box thinking, which there's nothing wrong with that, but it does get a little bit trickier. I will give you that.
Very good. Thank you. And you mentioned about being a student. So if you are studying and graduated and start working workforce, some cases you can count the time at school toward the 2 year of income. Am I correct here?
That is correct. Yeah. So that actually just counts just as if you were working.
And my understanding is you kind of need to work in the same profession that you got your degree in.
It depends actually on, again, this is going to be like outside the box here in this case. Most of the time, if you're working, let's say for instance, you are working at McDonald's during the time that you're going to school, but you're going to school to be a nurse, it does not have to correlate at all. You can be going to school to be a nurse, but still making money or, working a job on the other side, and they don't have to be the same. You just have to have the combined 2 years.
Very good.
Yeah.
My understanding is there's a lot of ways around 2 years.
Creative ways. Yes, exactly.
Creative, out of the box thinking, you called it. You just, as borrower, you just need to reach out and make sure that, hey, which box will fit your case, and then we can go from there. So you mentioned a little bit about the income, and you said for document wise, you need the last 2 pay stubs.
Correct. Yep.
So I have borrowers that are getting paid weekly or bi-weekly or monthly.
Yeah.
So you still need to see the last 2 no matter what kind of payment they're getting.
So it really depends, but from the last 2 pay stubs, I can see the big picture. I can see, and what I look for inside the pay stubs is I'm making sure that there are 2 things that I look for. First off, that your year to date, I look at that, your year to date income. If you look at your pay stub, usually it says YTD. And then what I have to look at and compare it to is the hourly wage that you're making. And so what I have to make sure is the hourly wage you're making lines up somehow or pretty dang close to year to date. What we have to, or what we're proving in that point is making sure that, let's say for instance, you took some time off. Well, then I can see that in your year to date and compare the 2 together. And then that's what we're working on to make sure that we're not running into a problem down the road. That's the biggest thing is we're taking care of things up front to make sure that we're answering those questions as far as like, does your income line up compared to what your hourly wage is? Does that make sense?
It does make sense. So you need 2 pay stubs to verify all that. Doesn't matter if it's weekly, bi-weekly, or
correct.
monthly.
Yeah. Later on, there will be an additional set of documents that I would then ask for. But all I'm looking for when I'm initially looking at your income is making sure that your dots, all your I's are being dotted and your T's being crossed. There aren't any holes. And then when, let's say, for instance, you go to purchase a home, then we can ask you for your up-to-date documents. And then just like you were saying, if you are paid weekly, then we're asking for 30 days of pay stubs at that point. Usually that's the final request, 30 days of pay stubs.
Okay.
So sometimes it's 4, sometimes
1,
5.
2, or 4. Or,
yeah.
Yes. Okay. And so that's typical for the best or the ideal borrower. He is an employee getting W-2 and pay stubs.
Yeah.
How about business owners? Like, how do you qualify that?
Yeah. So business owners, actually, this is what something that I really like doing because it does take a little bit more work, but there's a lot of fun to it. There's a fun factor because there is ways that we can, again, be creative in your income. But what we're looking for typically we're looking for about 2 years of tax returns. returns. Now, what we look at for those is we're setting a trend. We're looking for averages. We're looking to see how your business is performing. If you're looking from, let's just say, for example, from year 2021 to year 2022, if we see those two tax returns, if your income is going up, we're going, perfect. He's doing great. Business is doing great. That's a snapshot for us. Okay? Sure. And the most I've ever seen it go is 2 years, but sometimes we'll only ask for one. And that can actually be helpful. Let's say, for instance, for example, in this case would be if you've owned the same business for 5 years, or sometimes if you've owned the same business for 3 years, we can sometimes get away with 1 year's of tax return. But it's the snapshot that we're looking for. And an underwriter, and we'll get to what an underwriter does, but what they're looking at as far as the performance of your businesses. So it's just really at that point in time, it's a tax return. And then what we do to supplement that later on will be what's called a profit and loss.
Profit and loss. Yep. And my understanding is on the tax return, a lot of business owners will write off or report expenses to basically lower their tax consequences and how much taxes they need to pay. But some of these expenses you can actually add on to the income.
Correct. Or add back in is the term that we
back in.
Yeah.
Add back in.
Yeah.
Can you give us an example of one of or two of these expenses?
For sure. So let's say, for instance, your business says, and you have some sort of traveling expense.
Sure.
One of the most common ones that I see are cars.
Miles.
And what they do is depreciate. They depreciate the value of the car, and you can depreciate that asset, which the car is, inside there. So let's say, for instance, you go out and purchase a truck for $45,000. You depreciate that $45,000. It makes your business look like it lost $45,000, but you really didn't, because
you buy asset, you have a car.
Yeah, exactly. It didn't depreciate in over a year. But the nice thing is that $45,000 on my end actually gets added back in. So let's say you spent, $45,000 or you made $45,000 in gross sales. The nice thing is like you can offset that to where it looks like as if you were making that money back in. And you can do, let's see, another one are like office expenses. If you put it into there, there's a couple of different ways that you can do it there. But really the answer to looking at businesses and qualifying for mortgages with businesses is you want to talk to somebody a year in advance. My busy time of year is definitely the start of the year, let's say in January, because of the fact that people are trying to purchase a home. They don't want to make it to where they claim too much and then can't qualify for the home.
So just to rephrase, what you are saying is you can recommend and encourage business owners to check with you or the lender if they are thinking of purchasing a house that year before they file their taxes, because
before would be the prime word here. It's hard to fix them after they've been filed with the IRS.
Yes. So ideally you want to reach out to the loan officer and is like, hey, this is my business, this is my books, and I want to buy a house. What should I do here and there? And ideally having a loan officer working with your CPA that you'll get the best of the two worlds, the loan officer to purchase the house and the CPA to file your taxes. So we try to find a middle ground here when you can qualify for as much of a loan and pay as less of taxes. And it's not an easy task to do.
It's really not an easy task.
It's doable.
Everybody's trying to follow their own rules, their own guidelines. They're all trying to make sure they're within the bounds of the law. That can be difficult because I may say, hey, we need to do this. Could you make that change? Or can the CPA do this, right? And the CPA may say, well, technically, I can't do that. And you just have to understand that they're there to protect you as well. And everybody, just like you said, you're trying to find that medium ground. You're trying to work together as a team. I think it's literally one of the best teams that you can have is working for you, right? You already paid for a CPA to do that work. Now you just have one more professional looking at it, and then they're making and talking with you to help you strategize to help you make that work. Now, one thing I will say, and just to be clear, is I can't coach you on how to do your taxes, but I can say, hey, in order for you to, let's say, for instance, qualify for a mortgage at this point, at this value, your income needs to go up or it needs to go down, and you would need to get with your CPA to figure out how to to make those changes work for you.
Very good. That's really good explanation. I'm really thankful to have you here today. One other magic word.
Oh, yeah.
It's actually words. And it is FICO score.
FICO score, yes.
What is that and how that will affect the borrower who's trying to get a mortgage and buy a house?
Yeah. So magic word, I would say, is probably one of the... It's funny only for the sense that these are magical numbers, right? It hinges off of these numbers. Like there's these three major bureaus or these three major companies that are out here in the United States: Equifax, TransUnion, and Experian. And it's just really funny because they're the ones that tell you whether or not you get to buy a home now, or even a car, or even, let's say for now, it's credit cards as well. Any sort of credit, right?
Any sort of loan.
Any sort of loan. It's just funny because you don't know who they are. They don't know who you are, but for some reason they get a lot of say, right? And so it's really important, just like you said, it's magical. It's really important that we look into these FICO scores. Now, actually, it was funny. The other day you had mentioned to me what a FICO score was, and I'd never heard that explanation before. Maybe it would be good for you to explain that. What did you say to me the other day?
The way I explain it is it's the trust factor between the lenders and the borrowers. The more trust you have with building this relationship with the lender, the more they could lend you.
Exactly.
And so I count it as the trust factor. I couldn't, obviously there is no translation to other languages. It's just a FICO score.
FICO score, exactly.
Yeah, it's an American thing. Maybe Canada using it, I'm not sure. Yeah. But when I came from Iraq, the Middle East, we don't use that.
Yeah, and it's hard to explain, right?
Yeah, it's hard to explain something.
Who are these people?
Correct. That's not existed, right?
Yeah.
And it's easier to explain a doctor, a teacher, police officer.
Right.
But like, I don't know, a credit bureau is like, what's that what they're doing?
Oh.
And so
some guy on a computer somewhere looking at you, yeah.
So how that will affect the borrower? Is it like, what's the ideal credit score you would like to get? And how actually that affect the payment or the loan limit? Or can you just explain that?
So kind of to go off of what you were saying as far as like that relationship, that's what it really is. It's a relationship. And as you can imagine, what is it like? The estimated population of the United States, 350 plus million people. Yeah. It's hard for these companies to have a one-on-one relationship and know what your risk level is. And that's probably the other side to a FICO score, or the other side to that trust factor is risk. I mean, literally, that's what I deal with is how does all this work, right? And they give you this score to show you risk. So the higher your score is, the less risk you are. The lower your score is, the higher risk you are. And because of that, that's where the next part is. A good credit score when you're purchasing a home is anywhere from about, I would say, starting about 620. There aren't that many programs out there under 620 that would offer you any sort of help to purchase a home. I would say an optimal score, if it were me, personally speaking, would start at 660 and then going up. And at that point in time, you're actually receiving more help at that score. Now, it doesn't mean that you can't get a loan done or receive a loan. It just means that if you have a lower credit score, fees go up because of your risk. Right? And so just like what you're saying, what does that risk, what does that do? Well, it changes costs. It changes fees that they then charge to you as a borrower, right? Because they're like, well, you have to pay for the fact that you have a lower credit score.
Correct.
We're not going to pay for that. Show us how they, for some reason, I don't know why, and I mean, everything revolves around money, but how they feel like they mitigate risk or make that risk go away is have you bring in more money. That's how they feel. So what that does is like, let's say, for instance, on a FHA loan, which is a government loan that helps people purchase homes. Usually it's associated with first-time homebuyer programs. That's what most people associate them with. Their fees are off of that. So like you could get, what it affects are like your interest rate. If you have a good credit score, you can get, the best interest rate that there is out there. But if you have a lower credit score, you're just getting a higher interest rate because of your risk. Fees on the loan.
Yes. Mortgage insurance.
And they're just more expensive. It's just always, they just add more and more and more on top of things because, again, that's how they're mitigating your risk. That's how they're saying, well, in order for us to say say that you're not as risky, you have to bring in more money.
And what's the best credit score? I know it's like it goes to 850, but for a loan officer, if someone having, let's say, 780 and 775, is there any different in terms of the fees and the risk factor you were talking about?
So where it usually cuts off, now this year is a little bit different because they're trying to help people purchase homes. And something that we're seeing a lot more of today are people with lower credit scores. What some of the investors or like mortgages companies that they're doing is they're incentivizing you as the borrower for having a good credit score. So the highest incentivization score would be around an 800. Okay? But the majority of the time, I would say 95% of the time, it's going to be about a 740 to a 760, depending on what type of loan you're doing at that point in time.
Very good. So let's call it 740 and above. It's
740,
a good zone.
There's just a little bit of, just like I said, there's just a little bit less risk at 800. And there are some companies specifically that will incentivize you with being a perfect score, 800 score. Because anything above that score, I mean, it's amazing. It's the fact that you have an 800 is like you're a shining star to them. You're in the gold platinum group, I guess you could say.
Very good. So you mentioned a little bit about the first-time home buyer. And beside the FHA, is there like any other incentives and other programs that could help the first-time home buyer? Yeah.
So here's the thing is that in the state of Utah, I think that this is actually one of the most helpful as far as like programs that are in existence for helping people to purchase homes. Each program kind of specializes in their own aspect of like a first-time home buyer. I would probably just go over the most common ones that are out there. So like, let's say for instance, you have your FHA program, okay?
Yes.
That's like I said, it's a federally subsidized, meaning the government lowers their fees, they lower the interest rate in order to give you better terms on your monthly payment, out of pocket, those types of things. And what you would expect out of that would be like a 3.5% down is a usual. Now, and we'll go into this probably a little bit later on. After down payment, there are closing costs. So just be aware of that. You have what are called, and this I wouldn't say is like exactly a first-time home buyer program, but it is one of the best programs out there. But it's called USDA. It's a Rural Housing Development Assistance Program. For people who are out in Utah, it's going to be out west, like super far west. So like Saratoga Springs in Utah County, super far north in Salt Lake County, past Ogden area, basically. And then in super far south, let's say past Springville. Okay. And those ones are like 0% down, which is great. But there are restrictions on that one because they don't want you to have a lot of debt. And that's where, see, again, they're shifting that risk away from having the amount of money down. They're shifting that risk to having no or little debt associated to your name. And so they incentivize that portion.
Little debt beside the property you're buying?
Correct.
So typically it's like you have less student loans, car loans, credit cards. And
their number is usually about 45%. Max debt to income.
Yes, including the mortgage payment.
Exactly. Yep.
Is there a limit for how much you could borrow in that program?
No. At that point in time, it's just the limiting factor at that point in time is what is called your debt to income. The money that you make compared to how much debt you have. And the magic number would basically be about 45%. Yeah. Anything past that, you'll have to move to a different program that you could receive some help on something like that.
Yeah. So let's say I wanted to go far west to Eagle Mountain, Utah County, and purchase like 10 acres for, let's say, $2 million.
Okay.
Can I qualify for that loan? I mean, besides I have to provide the income.
Right.
But is there a limit?
So there are, there are going to be limits in that factor. Acreage size is going to be a limit. Like you can't do, I believe at this time, it's right around anywhere from 5 to 10 acres. I believe the 10 acre is probably your max, but it does have to have a home on the property. So that's another factor as well. And then just like you said, you have to be able to qualify for the fact that,
of course,
that's a $2 million home purchase at that point in time.
Yeah. No, I'm not buying that.
Yeah, you and me both. I'm okay.
I'm not there yet, but just trying to ask.
Yeah.
So you mentioned a little bit about the closing costs. So this is, again, one of the mysteries a lot of people having. And it's like, okay, so if I'm buying a house for $500, I can bring 3.5%. And that is let's call it 20,000, or that's 4%, so probably 17,500.
Okay.
That's toward the down payment.
Correct.
But how much should I count for closing costs, and what is closing costs?
Yeah. So maybe to add one, actually, to go back to those other types of programs, there are conventional loans out that actually will transition us into what you're kind of talking about right there as well. Conventional loans for first-time home buyers, as opposed to bringing 3.5%, you're bringing in 3%, which can be fantastic, right?
Yes.
Because of the fact that now, again, we're shifting the risk away from then, your debt to income, but really now we're looking more at how much money you're bringing in. Because again, we're looking to see what it is that's really important to you. You may have money, but let's say, for instance, you don't have, like, your debt to income is a little bit higher. Well, then we have to kind of start steering towards the programs that are available in that case. And to talk about closing costs, so down payment is, again, let's go over that first. Down payment is your risk factor. Again, I think that's the best way to be able to then talk about this loan. So all you're doing is you're saying, I'm bringing in money to make you, as the mortgage company, feel easy about me purchasing a home. I've used the term in the past, skin in the game. You're a lot less likely to walk away from something if you've put down a substantial amount of money. Right?
Of course.
And so that's what they do there. And then on top of that, you have what are called closing costs, right?
Yes.
Your closing costs are going to be the fee that's charged to you, like from me to close the loan, meaning like, so what you'd be paying for at that point in time would be your underwriter, because I am what's called a direct lender, meaning like I do everything in-house. And then what I do is I basically sell that loan to somebody outside in what's called the secondary market. Okay?
Yep.
And so you, as the borrower, never pay me. My job is to help you close the loan, and then after you close, I get paid. I never receive any sort of financial gain from the borrower. Okay.
Yes.
The second thing is
until they get closed.
Yeah, until they're closed, right? But I never receive it from anybody. Like I see my payment would be the happy and smiles that I see when people sign.
Of course.
That's what I can get. But then you have what are called your escrow fees. Escrow fees are your taxes, your insurance, and any fees that are associated with the loan. Let's say your mortgage insurance, if there's any fees that are attached to those types of things. And what they are basically, it's the mortgage company or the bank setting up like a savings account for you on your behalf. So that way, when in November in Utah, usually it happens, I would say 90%, maybe a little bit less, of homes or counties, they require you to pay your taxes, your property taxes in November. And so we have to create this account for you that pays out and is ready to pay out every year on your behalf. Same thing for your insurance, your homeowner's insurance. And if most of the time you're not going to have to deal with any of these, but like if you have mortgage insurance, any type of fees like that, but most of the time, I would say 99% of the time, you won't even see those. Okay.
Correct. You don't, make the monthly payment. Yeah. And portion of that will go to the escrow account, which you are saying is. Yeah. So as an estimate, how much is the closing cost?
The safest thing I would say for you to do would be to think in your head, and again, it's not going to be exact, anywhere from 2 to 3%. That would give you enough. That would give you enough in your mind to be able to be safe. Now, let's say, for instance, you come to the table and you're like, well, I've saved more than that. Yes. Well, then what we can look at is if you're willing, of course, right? If you're willing, you can take that money and apply it towards other things, meaning you can buy your rate down. Let's say if today's rate was a 7, okay? Yeah. And you said, well, if it cost me $3,000 to buy it to 6.875, which is an eighth of percent, it would save you, right? Whatever that monthly payment would be, that 8%. And so that's a part of your closing costs. Those are not something that I don't, as a lender, we don't make any money on those. But what it does is it does increase your out-of-pocket costs.
Of course.
So I would say anything that you select as a borrower is something that will cost you out of pocket later on.
Very good. Well, Tyler, these are all my questions. Do you think we missed anything? Should we talk about something else that it's very important you need to mention it today?
You know, the funny thing is you asked me, what is a mortgage?
Yes,
what is that? What does mortgage even mean?
And why they call it a mortgage, yes.
Why do you call it a mortgage? And this, I think, is actually funny. It's actually a French word. Morgue or mort in this in French actually means death. And gidge or gadge, whatever you want to say, I'm sure there's some French way of saying it, means death. So together it means death pledge. I thought that was really funny. It doesn't mean that that's what it means now, right?
Okay.
But it's a pledge, right? A mortgage is a pledge for you to pay back something that you borrowed. So in this case, you borrowed money to buy a home. So it's your pledge to pay that back. Nobody's going to kill you in that sense. I thought that was hilarious because some people think it could be.
Yeah. Well, I'm glad I don't understand French. So.
They were really serious back then, right?
I know, right? Yes. You are taking a mortgage. You paid back.
It's a pledge. It's a death pledge.
Very good. So, Tyler, thank you so much for your time and all the knowledge you have. And thank you for sharing that with us today. If people wanted to reach out and, know more, how can you help them? And what are different programs that could help them with their purchasing the house? How can they find you?
Easiest place to actually find me is on a phone call. My phone number is 801-854-3002. Please, if you have any questions, concerns, comments, give me a call and I can work with you to help you get that ready to go. And if it is that you are looking for a home purchase, I do know this amazing realtor that can help you out and help you make that happen as well. Dreams become reality when you get the right team members together. So
Absolutely. Well, thanks again, Tyler. That was awesome. I really appreciate your time and looking forward to talk to you again.
Thank you, Mohammed. I appreciate your time as well.